Howdy all, so this video we're going to talk about the basket case, that is Deutsche Bank and one single lonely trade to place. Right, so yeah, this is my favourite bank, been following it for years and years and years now, and it really is a train wreck. It's interesting, I put this post out a fair while ago, in a few different places, and I've seen a few people say, "Oh no, this is just a restructure. It's just a restructure." That I think that's very short-sighted. If for those of you who are thinking it's just a little restructure, there's on so many levels. I mean, for one thing, in business, if you have a business that is absolutely beasting it and doing well, you don't have a massive restructure. You don't shut down buildings, and you don't cut 18,000 jobs. You only do that when things are close to the edge. And this is not the first round of job cuts. They have cut thousands upon thousands of jobs over the last 6 years. And what all they're doing is putting plasters over gangrenous wounds. But Deutsche Bank has gangrene and cancer and every other bad ailment you can think of. So it's literally just a case of when will they go to zero, or when will they be bailed out of some sort. And it's, so I'm going to try and answer all these questions. So basically, I'm going to try and simplify this as much as I can, okay? And in the most basic way I can do this is, let's say you have a bit of a basket case of a person here, okay? And let's say they have borrowed massively, okay? They're over borrowed, let's say. They've over borrowed and they've also over traded, okay? So let's say it's a person, a sole trader of some sort, and they've, their lifestyle's gone too high for their income, blah blah blah, and they keep borrowing money, and all of a sudden shit really starts to hit the fan, and this person can't pay their bills. So all of a sudden, this person has to default on an invoice that this person is waiting for. It could just be a normal invoice. What's going to happen is this person is going to start defaulting on all the obligations that this person also has. But don't forget, because let's just call this person Dave. Because Dave balls up, DB, Dave balls. So because Dave has screwed up the payment or the invoice to this person here, this person now has extra worries because this person can't pay back other things. So this person will probably then start defaulting on this person and this one. And don't forget, this person is probably going to start defaulting. And just let's say Dave owes huge amounts of money to all these people, and all these people are relying on this big chunk of money coming through. And if they can't do that, everyone's going to default with each other. So it becomes a bit of a clusterfuck and a bit of a mess. And that is the most basic way of putting it for the moment. And you have to just remember LTCM. So if you Google LTCM, long-term capital management, basically, it's a fascinating story in itself. I've mentioned it probably quite a few times now. But what happened is, this was the biggest super hedge fund ever. Well, not ever. Back in the day, it defaulted in 1998, but they had the world's best scientists, mathematicians, portfolio fund managers, everything. And it was the Titanic of funds and hedge funds. And basically, a whole spiral of events caused it to go bust in 1998. From basically, the South Asian pandemic spilled over into Russia. Russia defaulted on the ruble. That killed a whole bunch of South American funds, and then LTCM was screwed. And this was just a relatively small one. So when you compare our little web of derivatives or web of exposures compared to DB, Deutsche Bank, it's on scales which are just monumental. They have $48 trillion in derivatives. It's just nuts. There is no other bank that has a bigger derivative exposure. And when you're comparing that exposure, I mean, the whole of the EU's GDP is only 14.6 trillion. So these are bets upon bets upon bets, basically. Because sometimes you have, and a lot of these derivatives are synthetic derivatives. And a synthetic derivative is basically a bet upon a bet upon a bet. So, for example, if you, let's just clear all of this. Let's just say there is a race. Wait, I need a pen. Okay, and there's two people betting on the race. Okay, and let's say this person is betting on, I don't know, this horse winning, and this person is betting on this horse winning. Okay, so they both have a bet between them. And this bet, I guess you can sort of call it as a derivative, because they're basically trying to make profit based on an underlying asset or a thing which is elsewhere, i.e. these horses. Horses? Yeah, horses is plural. But a synthetic derivative is where you then have someone else, or two other people, having a bet on the outcome of this bet. So this person is basically saying, I think this person's going to win, and this person thinks, nah, this person's going to win this bet. So they then have a bet between each other. And then guess what? You then have other parties doing the same thing, having basically a bet of, oh, I think this person's going to win. And it's all derived from one single tiny underlying asset or thing or an event or something. And this goes on for hundreds fold. It's ridiculous. And this is one of the reasons why you have such a big derivative exposure, when really, yeah, there's about 50 trillion worth of derivatives exposure, but it's probably only a few $100 billion worth of actual assets or things that they're betting on. Yeah, and this also takes us back to the old seesaw analogy, which I've spoken about a few times as well. Basically, if you have a seesaw, let's move this, let's start down here. Okay, and you put, I don't know, $1 billion worth of bets on one side. What tends to happen is most banks and hedge funds, they hedge. Okay, so they're always hedging their bets, and so the net movement in this, the net exposure is zero. But what's the gross outlay here? The gross sort of the total amount of things on the seesaw is $2 billion. Let's then escalate this, and this keeps going up over the years. This is now 1 trillion. It's then balanced out over here. 1 trillion, and this is, by the way, is a bank. Okay, the bank's books or bank's order book of some sort. And let's say it gets to the point where it's now $10 trillion. $10 trillion. The silly risk managers and analysts are going, oh no, the bank's fine. We have zero net exposure here. When in fact there's actually $20 trillion on the seesaw right now, and it's the black swan event which they're not thinking of. So either an earthquake could gobble them up, a sinkhole collapses and the whole seesaw collapses, or the plank, this seesaw plank snaps, or some tiny something else, another entity somewhere over here, just removes 2 trillion over here. So now you got, oh my lord, we've got 2 trillion of net movement, and although it may have wound down, there's only 18 trillion on the board. All of a sudden this becomes a waterfall of destruction. I'm using all sorts of analogies at the moment, but yeah, hopefully you can sort of get the point. And it's interesting. I've made loads of videos before, but I found this one came to mind. This is in 2017. I was in South Africa. Yeah, I quite fancy an ice cream now. If there was going to be a bank that's going to go bust at some point over the next few years, it's this one here. And that was quite awkward, because as I was making that, there was a whole bunch of Deutsche Bank employees coming out there looking at me going, what? So it's just nuts. And also I've been looking at the share price. So this is the weekly chart. It's been falling for freaking ever. For several years it's been below the 2009 lows. So as of 2016 it dropped below the 2009 lows, and it hasn't really looked back. And I guess when you compare this to something like the S&P 500, S&P 500, no, oh yeah, here it is. No, not that one. SPX. Let's just put SPX. So this is the S&P 500. Oh, it's the wrong one. It doesn't matter. Same thing. So as you can see, the S&P 500, the biggest index on the planet, the mothership as I call it, Deutsche Bank and the S&P 500 are very highly correlated. So everything basically shat its pants in 2007, 8, hit the lows in 2009, and then we had the bounce. And everything was hunky-dory, and they had, everything was correlated. Obviously the S&P out-accelerated it because it's not just banks, there's everything there, whereas this is just a crappy bank. But all of a sudden you started to see a divergence over time where the S&P just went ballistic, and so did many other bank stocks, and Deutsche Bank just started dying a very slow death. They're cutting 2,000 jobs here and there, removing buildings here and there, and then this happened. And when this happened, I was like, right, expect the retest of this level, and it's been game over ever since, really. So let's just get rid of that, and yeah, this is going to go to zero. It will go to zero, or we'll have some sort of bailout. So in fact, let's have a little chat about that. So as mentioned, there's really only two outcomes here. It dies like Lehman Brothers, or it gets bailed out. Well, so everyone's expecting the bailout issue, but I think it's too big to be bailed out. So what they're doing is this bad bank thing. So what they're trying to do is, let's just get this back out. Paint. I love a good paint. So you have DB over here, and it's order book of stuff or everything it's doing. Oh, and by the way, I forgot to say, it only made something like 269 million euros or dollars. In fact, let's just quickly fact check that 1 second. I'm going to pause the video. Sorry, it's 229 $229 million profit. Okay, so the average Joe, this sounds like, wow, okay, they're making loads of money, but for a bank, that's pitiful. It's absolutely pitiful. There are tiny random like banks in Florida or California which makes more profit than this, and so let's just say they've got this much of good stuff, and the rest is bad. Okay, so what they're trying to do is create a bad bank. I mean, the Bank of Scotland, they did this, and there's a few other banks that have done this. So what they're trying to do is create a new entity and call it as bad bank. And they're trying to offload all of the crappy stuff to this bad bank so they can slowly unwind. Basically, they're going to try and destroy all of the bad stuff and slowly unwind the bad stuff and try, and that is the key word here, try to keep the good stuff within Deutsche Bank so they can limp on forever. That's the plan. It has worked in the past with other banks, but nothing has been on the scale of Deutsche Bank. So, yeah, it's interesting. Whatever you see on the news, and I would take with a big pinch of salt. This is not good. So going back to what's happened here. So basically, the questions are: what should we do? Do we pile into gold and silver? I think gold and silver will do well when we have the eventual financial crash. I mean, if we just get the S&P 500 up, go on the weekly chart. So as you can see, the S&P 500 is still on a tear. It's been absolutely beasting it. And yes, gold and silver have been doing quite nicely recently as well. We will not see proper gold and silver prices rally and properly soar until the market crashes. So until we have movement coming down here for the S&P 500, which will be the same with all the other indices around the world, we won't see gold and silver mooning, so to speak. So gold and silver, yeah, great in the long term, but as I've always said for a number of years now, gold and silver will not rally hard until the financial system crashes. But the thing is, when gold and silver, so when the financial system crashes and when gold and silver will crash with it. So a lot of people think that gold is inversely related to stocks. In the old days, yeah, that was the case. But when you have, let's look at gold here, again on the weekly chart. Look what happened in 2008, 2009. The whole world was ending, but what did gold do? The gold literally just threw in the towel as well. Gold hit basically 1,000 all the way down to 700 during the crash. But what happened is that all the strong hands, all the people that really understand gold, they were buying like physical stuff around the 2008, 2009 lows. And then were nicely rewarded. And the reason this happens is because all the physical gold disappears because everyone's hoarding it, like Russia and China. And then there's a supply squeeze, a physical supply squeeze. And so the price shoots up and is then reflected as such. So what's likely to happen is if the S&P 500 falls over, not if, when, gold will fall with it temporarily. And yeah, then gold will rise. So yes, if you're looking for the long term, yeah, gold and silver is fine. But really, cryptos are uncorrelated, so to speak. And you're going to see far quicker returns with cryptos before gold and silver. Again, it's a joke when you compare Bitcoin to this. Bitcoin USD, let's get the Bitstamp one, it's longer history, there we go. It's just ridiculous. But yeah, so I mean the goal for me has always been make shitty profits with shitty cryptos in the short term and divest into gold and silver, land and businesses. That has always been the goal. So that is that. What should you be doing to prepare for this? Or Anita, you know how you're learning how to trade. So that is it. When this happens, I will be shorting the indices. So we should see at the very. In fact, let's look at the German. Let's look at the DAX. If you're looking at the DAX, I'm expecting the DAX to fall at least back down to the 5,000, 4,000 level. I would say there's a bit of a range, not range, but as in sort of this sort of level here, which means you have, I mean, from where we are now, there's 6 to 8,000 points of profit or potential movement to get. So that's short it. And looking at this, is this? I mean, what this could be, again, this could, big question here, this could be the right hand shoulder of Head and Shoulders. So shoulder, head, shoulder, neckline, and then see you later, alligator. So that's that. Have I missed anything? Yep. What positions you taking? Nothing yet. I'm just going to wait till we get the tumble, then I'll get in on a pullback. Yeah, what's stopping the ECB trying to do a fudge? There's nothing stopping them. They can do whatever they want. The IMF, the ECB can just print euros. They can do whatever they want. Ultimately, whenever you see a bailout of this sort, it won't be bailed out in dollars or euros. It'll be done in a thing called the SDR, special drawing right. It's basically currency that the IMF prints. I don't think they can kick the can down the road anymore. I really don't. I think if anything, they'll try some sort of bailout, or even a bail-in if it gets that bad, like Cyprus. But yeah. So that's that. Let's as I said, we've got a trade to place over here. We in fact we text out a trade, yes, or I text, yeah. So the pound dollar trades are still haven't been triggered yet. The Aussie yen we got stopped out -1R, so that was only a 0.2% loss on that trade. Yeah, I was trying to, let's look at Aussie yen. As I said, the 7,600 level is being smothered. And I was trying to get a pop to the upside, but it basically wicked us in and then took us out just. It could still happen, but as I said, it was a very short-term play, that one. Anyway, the trade we're placing right now is Euro Swissy. So as you can see here, the bigger picture is that it's drifting downwards, so to speak. So overall momentum is down, but I think we're having a classic pullback for a bit of a break to the downside. We're having a bit of a compression here. So what I want to do, let's get rid of these here. I want to basically get in just below the 5-0 level here, and then have a relatively tight stop actually. So I'm gonna have a pretty super duper type stop actually. I'm gonna have a, it doesn't, if it breaks, 1 second, yeah, above, I'm gonna have a 35 pip stop. So again, with this trade, I'm only gonna risk 0.25% on this one. So 35 pip stop, 0.25, so 125 quid risk on this, 124, that's fine. And then yeah, I'm going to trail this one down. So that's that, yeah, aiming for a bit of a pullback before the breakdown. And yeah, hope that makes sense. I will see you soon. And oh yeah, don't forget to get yourself onto the cuddle. It's the 26th, so yeah, wherever it's gone. Yeah, just check the calendar, click on the link, and yeah, the trading battles are going to be fun. Anyway, toodles.